Evening. Welcome to the loan officer training with the mortgage calculator. Today we're going to be talking about how to execute a BRRRR transaction for investors. BRRRR definitely a hot topic right now, and we actually did our daily rates live show today on this strategy. So very fitting that we're going to do this training tonight. We'll wait just a minute here to get started to let us go live on all the different platforms. We appreciate everybody tuning in nice and early. I see comments already coming in there. Feel free to drop a comment there as you tune in. We definitely appreciate it. And we'll get started here in just a moment. All right. It looks like we're live on all the different platforms. So we will go ahead and get it started. All right. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator. I'm joined here by our sales manager, Jose Gonzalez, and we are a correspondent lender. We specialize in non-QM loans, and what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is this loan officer training where we pick a new training topic. Today's topic is how to execute a BRRRR transaction. So BRRRR stands for buy, renovate, rent, refinance, and repeat, right? We're going to buy a property, we're going to fix it up, we're going to rent it to somebody, and then based on the fact that it's improved value and rented out, we're going to refinance it out of, whatever we had it in, whatever loan we had, or maybe we bought it cash. And then at that point, we're going to take that cash out of the property and go purchase a new property, which is where the repeat comes in, right? So great concept here. We love it. Nick and I, embrace it personally as well. But I will go ahead and let Jose, our veteran here with 28 years of experience as a loan officer and a realtor, who's helped Nick and I on both sides of a bunch of our transaction as well. We'll have him break it down further here. So Jose, if you're ready, we can go ahead and get into your presentation.
All right. Good evening, everybody. How are you doing today? Thank you for joining us tonight's training. Yeah, it was pretty exciting this morning, going over the fixed flip loans, those high loan to cost, high loan to values, the DSCR, no seasoning. So we're gonna break it down tonight in more detail, so those people that tuned into this morning's show can really benefit, because here we're going to explain how to execute a BRRRR transaction. This is the rage. As we know, investors are driving the market, right? We can definitely vouch for that here at the Mortgage Calculator, because we do specialize in dealing with investors, and definitely a lot of investment loans have been going down. And the beautiful thing about the investors is that they don't come with just one property and one project in mind. The real investors usually have multiple things going on at the same time, selling a few, rehabbing a few, buying a few. So they definitely keep us busy. We know non-QM originations have increased as a response to higher rates, driven by the non-QM driven by more investor demand for properties. Low property inventory for sale has made rehabbing even more profitable, right? They rehab existing property and they can either resell it or they can hold onto it, because rents are rising faster than the interest rates, which makes these fixed flip loans converted to a DSCR loan, for example, seems to be the most popular path. Extremely popular, and the reason why the DSCR loans seem to be the end loan of choice on these transactions is number of reasons. There are options with no seasoning on title, and I'll explain that to you in a minute as we go into the presentation. But they have no seasoning on title, which means that you're going to get the market value versus the purchase price plus renovations, right? And they also do not qualify the borrower based on their personal income, but on the gross rental income generated by the property, because DSCR stands for debt service coverage ratio, means the ratio that the gross rent is covering the total housing expense. Um, Preferred scenario is at least a 1-to-1 basis, or a 1.0 DSCR. That means that the gross monthly rent is covering 100% of the housing expense. That's going to give you the best options. And then if you DSCR above at 1.25 or above, or the higher you go, you get better cost on the rate. But the highest LTV, you're going to need at least a 1.0 DSCR to get that high LTV, that 80% cash out refi with no seasoning, that or the 75, whichever you're going to do. So BRRRR, buy, rehab, or renovate, as Kyle mentioned, rent, refinance, and repeat. And we're going to break it down to you how this is possible. Okay, but it is essential. One of the most essential things when you're consulting your investor, or if you're the investor, obviously listening to us and you're going to be reaching out to us for the consultation, is to plan for the exit strategy. This is critical because in some cases, depending what your exit strategy is going to be the loan amount you're going to get, or maybe not get the deal, because sometimes when you have less meat on the bones on that flip, they may only do the deal if you're going to hold it rather than if you're going to sell it. That's odd, but that's just how they look at it. So definitely plan for the exit strategy. Are you going to flip it? In other words, sell it? Or, like a lot of our investors are doing, are you going to hold it? So whether you're going to, if you're going to hold it, more than essential than if you're going to flip it, a rental market study is essential, right? Why? Because you want to make sure what type of end loan you're going to be able to get if you're looking to do a DSCR loan, right? Now, all income types are possible on that refinance flip loan, the end loan that you're going to get. But keep in mind, like I just mentioned, only the DSCR has zero seasoning options. That's critical because time is of the essence for the investors. Now, you can do on your end loan, like I said, there's no limit. You can do a full doc loan. You can do a bank statement for income loan. You can do a profit and loss for income loan. You can do a 1099. Obviously, bank statement, profit and loss, and 1099 are for self-employed borrowers. Or, like I was mentioning, you can use the DSCR loan, which is going to use the property's rental income to qualify the borrower. The DSCR, like I was mentioning, is the preferred loan type for the experienced investors that have multiple properties, because we know how complicated it can get. They have these multiple properties, resulting in, especially if rehab's going and a lot of expenses, a lot of write-offs. The tax returns are not going to look good, right? But the cash flow on the properties are going to be great. So you got that component that's going to make the DSCR a better option, and then the seasoning option. Because if the investor desires less than 12 months seasoning on title options, right? The only one that's that's going to allow that is the DSCR, because otherwise, if they go with any of these other options that have 12 months seasoning on title, and they want to refinance with less than 12 months seasoning on title, the appraised value is going to be the purchase price plus renovations instead of the market value that you get when it's a no seasoning option. So, real important point to consider when you are consulting your investor regarding the end loan, because that's where you as a consultant are going to be an invaluable member of the team, because you're going to help give them the data that they need to make a solid decision on if they're help them make a solid decision, should I say, um, on whether they're going to flip the property or if they're going to hold it, right? Because definitely you're involved here in the initial flip loan, but then you're also going to be involved in the end loan when they refinance out of that flip loan into whichever is the best option for them. But like I mentioned, DSCR is usually the one. So for those of you that need a little bit of refresher here, what is a fixed flip loan? Well, very important to note. It is a short term bridge loan. It could be 6 months, could be 12 months, depending on the scope of the work, could even be 18 months, right? It's a short term bridge loan designed to help investors purchase and renovate a property, usually to sell it at a profit, but also to facilitate the repairs if the investor decides to keep it and refinance out of the flip loan into a long-term loan. Now, a fixed flip loan can also be used to refinance an existing flip, which I'm going to get into that in one of the next slides. So it's not just for purchase. It could also be used to refinance the property that you already own. It could just have been purchased cash. The renovations haven't been completed, or some renovations could have already been completed, but now you need more money to finish, and now you're going to refinance that property into a new fixed flip loan. Now, it's obvious only for investment properties, and we got loan amounts anywhere from $50,000 to $5 million for these fixed flip loans. So let's talk a little bit about the terms because I've been throwing around seasoning on title and this and that. So let's just give you a little refresher because I like to empower my audience just like I like to empower my borrowers. Right? The more information you give them, the better they can assimilate uh, what you're explaining. So, what is seasoning on title? Well, seasoning on title is how long the property owner has been on title. How long have they owned the property? The best options on seasoning for DSCR there's more options with 6 month seasoning, right? That's the more common DSCR option with less than 12 month seasoning. But we also have options with 3 month seasoning and options with 0 month seasoning. Now, the 3 month seasoning uh, obviously is going to have better rates than these 0 months. On the show we did this morning, I think it was like a 0.875 lower rate for that 3 months than 0 months. It is a no, shit, that was like a point 0.5, excuse me, point 0.5 lower rate on 3 months instead of 0 months. We have a recourse loan. A recourse loan is where the borrower personally guarantees the loan. Non-recourse loan, the borrower does not personally guarantee the loan. Now, I will state all of these loans that we're looking at here, all of these fixed flip loans, all of these DSCR loans are all recourse loans. Right now, some may not show up on the borrower's personal credit report, but that has nothing to do with the loan not being personally guaranteed. That just means the loan servicer doesn't report to the credit bureau. So some DSCR loans have that benefit, and most of the fixed flip loans are that way. They don't report on the borrower's personal credit, but they all are personally guaranteed. ARV is the after repaired value. That's the value of the property after everything is complete. As is value is the value of the property in its unrepaired current state. Renovation budget is the total cost to renovate the property. Soft costs are expenses associated with the planning and development of the project, including architectural expenses, engineering tests, and permits. Hard costs are actual construction costs like materials, labor, and contractor overhead. These are all critical terms you need to know because those are all terms you're going to need to complete when you're searching for quote options for your fixed flip loan. Now, what are some of our fixed flip investor concerns, right? Well, they're going to ask, can I finance 100% of the rehab? Yes, we can. Usually we can finance 100% of the rehab and up to 90% total loan to cost. Now, they're also going to have a limit on the loan to ARV, which is going to be lower, right? But usually the 90% loan to cost ends up being a lower figure if you have a really high ARV. So we can always finance 100% of the rehab, but up to 90% of the loan, total loan to cost. Investors also like to concern how much experience do I need? Well, we have options with zero flip experience for a borrower with good credit and a profitable flip. That's a critical component because remember it's risk assessment. If the higher score is going to have a lower risk. So then if you have zero experience, that's going to offset it. And usually what happens when you have the zero experience flipper with let's like the quote I did this morning with a zero experience flipper, 740 credit, and we had a flip with a good ROI. It had like a 52% ROI. That person got 75% loan to value on the initial distribution. That means the closing. So if it was $100,000 purchase, for example, they would lend the initial draw would be 75,000. So the bar has to give 25% down, right, of the initial cost, the as is value, the as is purchase. Um, so that's critical because in that same scenario, I run it with a 670 credit score and it'll give a no option. So that's one thing to note. Zero flip experience is possible. You just got to run it through the pricer, set up the deal, and see if a viable option comes up. Uh, they also ask, do I need to make any payments during the rehab? Well, no, not necessarily. It really depends on the profit in the deal because if the flip is profitable enough, right? If there's enough meat on the bones, if the ROI is good on the flip, then the interest payments can be worked into the loan, resulting in no out of pocket payments. So there is an interest expense, right, for however long you have that money. But if it's a 12-month loan and you got a lot of meat on the bones, they will work in the 12 months interest expense into the loan. That's the interest reserve, as they call it. Now, in some cases, less flip. I mean, more flip experience. They're flexible on that, but just consider good meat on the bones. You can work it in. Now, less experience, they may let you work less of the interest reserve into the loan. More experience, obviously, you get a better loan, right? Higher loan to cost, then you can work in more of the expenses into the loan. Now, here's one a big misconception. How much income will you need to verify? Well, we don't need to verify any personal income. You don't need a job to get a fixed flip loan, just like you don't need a job to get the DSCR loan, right? That's why it's so popular. Because uh, the flip considers the profit in the deal as the income that is going to be considered, right? The return on investment, the ROI on the flip is the income, right? Higher return on investment means higher income, net income for the deal, more profitable deal, better terms, right? Up to the max, which would be 85% initial distribution and up to 90% loan to cost and always 100% of the rehab. Now, here's another one that's really good to note. They're going to ask you, can you pre approve me for a fixed flip loan purchase? The answer technically is no, we cannot. We can partially pre approve you, right? We can review your credit to see where it falls in the grid. We can review your track record, which is the industry term for your experience, right? What's your track record in the last 3 years, right? That's what they're going to look at how many flips you've done in the last 3 years. You got to put it on the spreadsheet and all that kind of stuff. But the final say will really depend on the profit of the flip. So you will need an actual property and the scope of work, right? You need to know how much renovation, the ARV, the as is value, all the renovation, scope of the work, meaning the renovation. So all of the components that you're going to need to set up the flip to determine the profitability of the flip, because without the actual property, you only have part of the deal. You have only the credit and the track record, but you don't have the income. So we can't pre-approve anybody without knowing what's the projected income on the deal. Now, if they give you some numbers and they say, yeah, this is for such and such property that I looked at, and these are my numbers, then yes, we can pre-approve them for the deal, of course, right? You're going to run it through the pricer. It's going to check out. You've confirmed that's the actual data. Boom, you got your pre-approval, and then they just need to give you the contract so you can get the deal going. And like I mentioned to you, I would gonna touch base on this. So, can I do a refinance of my incomplete fix flip purchase? Yes, you can. Now that's gonna be obviously a reduced LTV and all that kind of stuff, because they're going to look at, is it incomplete because you already had a fixed flip loan, or is it just incomplete because you were using cash? Now, if you were using cash, your own money on the deal, then that's going to be a lot more favorable than if you did another fixed flip loan, ran out of time, they don't want to extend you, now you need to go to another, to get another fixed flip loan. But it is possible. But what usually happens in a refinance of a fixed flip purchase is that it was either a cash purchase, they bought the property cash, right? They had damages, they didn't want to do hard money for the purchase, they had to do it quickly. It was an on the spot situation, they didn't want to lose a deal. But now, as is the case, they don't want to keep all their money tied up, right? So you can refinance that fixed flip purchase as a delayed finance fixed flip loan and get your loan based on the same parameters, right? You're obviously going to get some credit for the money you put in there, all that kind of stuff, and then put it into the pricer, get a loan, get an LTV, all that kind of stuff. I mentioned the in process rehab can be refinanced. And then obviously the last refinance option would be the investor can keep the property and refinance it into the end loan, which is the whole purpose of tonight, is BRRRR. That's the refinance and repeat part, right? But these are a lot of questions they ask, and it's a lot of good answers here, so you can be aware of the scenario when you're consulting your investor. So we mentioned the whole scenario. Let me, before I go into that slide, because that's going to break down the actual deal. Remember what we're doing here now. We're doing the BRRRR, which is going to be the refinance, and then the repeat part. That's going to be the emphasis. So essentially, we're going to pre-approve them, and we're going to approve them and close first on the flip loan, right? Which is what's necessary to renovate the property and purchase it. We're going to assume in this case, our investor used the loan to purchase the property, right? So this is our scenario here. Now, even though it says 10 plus flips, this is actually the scenario I ran this morning as well for 3 plus flips, for 3 flips in the last 3 years. In my scenario, I had $150,000 purchase price, which was also the as-is value, $75,000 in renovation, $350,000 in ARV. Our loan to cost came up to 89.41%. That's the cost. The initial cost, 150,000 plus the 75,000 was 89.41% loan to cost, and we're 85% LTV in the initial distribution. So in this scenario, the borrower got $127,500. You see right here as the initial advance. That's at the closing. The wire was for $127,500, and the borrower had to pay the difference, right? The down payment and their closing costs. And then if you add up the rehab budget and the cost of the overall loan amount were 89.41. So our 202,500 is 89.41% of the total cost of the project, which is pretty amazing, right? Our borrower loved it. He did 15% down on this totally damaged property that cannot be financed any other way for the investor if they're looking to flip it, right? That's the key here, or looking to hold it, which means they're going to refinance out of that loan quickly, right? So we would not be doing like your usual Fannie Mae. There is, I think, like a renovation loan that you can do investment, but it's very limited and it's full doc, right? This is not full doc here. This is strictly the income is the profit on the flip, right? I mean, anybody can qualify for this with the credit and a profitable flip. That's the key, and the assets. So you got them the deal, you got them the loan, they closed on it, they're about to finish it, and then they're talking to you, Jose, I'm gonna keep that property like we discussed. Man, it came out so beautiful. I was working on the property there. People stopping by asking me, "Wow, this property is so beautiful. I've been checking it out while you've been fixing it for the last month. Are you gonna rent it? Or are you gonna sell it? Because I love the area. I got the guy's telling me he has people lined up that want to rent the place. They're gonna give him, $3,000 a month. It's a beautiful thing. He's gonna make money. He's gonna keep that property, right? So then, obviously, we already gave them this deal, right? But this is what we're talking about here. This is what you got to do up front, and then this is what you're going to offer him in the end. A zero seasoning DSCR cash out refi. So, and this is where we break it down, right? This is where the investor is going to be ear to ear smiles, right? Because you're giving him this amazing option here, $262,500 loan, $350,000 market value. They're going to refinance their $202,500 into a new loan of $262,500 at 75% LTV. They're going to recover their $22,500 down payment. They're going to recover their closing costs, right? And they're going to get $60,000 cash out, basically there. So this is a win-win situation for the investor, because they're going to walk away from the table with 60 grand, basically, right? 60 grand in their pocket that they're going to then be able to use for the repeat part, right? Now they're going to go buy another flip. And on the last one, remember how much money they needed on the last one. They only needed 15% of $150,000. So that was, they only needed $22,500. We're giving them 60,000, so they can find another one. They have the money to put down. They're going to have some extra money left over. They're going to do the whole process again, and they're going to end up hopefully with another 60, 70, $80,000 back in their pocket to recover their down payment and go back and buy another one. And that nest egg will keep growing, right? It's 60,000 on this one, take away 22.5, let's say take away 30. So now they got 30 there on the side. They do it again, they get another 30, 40, they do it again, and they're creating an inventory, a portfolio of properties that is generating income for them and that are appreciating, and which means that they're generating wealth. The investor is creating wealth by these assets, right? That's why real estate is, probably the best investment, because you have an investment, appreciate a real investment, right? It exists, appreciating in value and generating income for you every month. So it's a great way to leverage yourself out. So, I mean, great options here. Really looking forward to either our investors that are out there helping you structure your flips, or our loan officers that are out there helping you structure your flips. Those of you that are on our team, you know where to find us. Those of you that are not on our team yet, you also know where to find us, and you want to join the team that's going to give you over 5,000 loan products to offer to your customers, including an amazing array of investment property loans. So I do see that we have some questions there.
Oh, let's see here. Let's check it out. I see one question, I think.
Yeah.
The question is, do permits or proof of renovations have to be provided to refinance the loan into a DSCR?
Well, not exactly, but you're gonna have a property with no open permits, right? I mean, you're gonna have to have a property that's complete. You would not be able to refinance an incomplete renovation into any type of loan other than into another renovation loan because property condition would not allow you to close. So you don't have to provide proof of the permits or proof of the renovations. As they say, the proof is in the pudding, right? You got a completed project. Hopefully, you don't have any open permits or code violations or anything, because remember, the title work is going to be completed. Title examination, they're going to look for all those kind of items, and if you have any of those issues, they're going to have to be resolved. But sometimes some of these jobs are done with no permits because you don't need permits to paint a house and fix certain minor items. So it really depends on the scope of the work that was done. But the main thing to note is that the renovation has to be complete. You can't have a house like, oh well, I got the kitchen cabinet sitting right there. They're going to be put in next week, and the appraisers there looking at the home like, okay, fine, I'm going to appraise it, but then I'm going to appraise it subject to completion of the repairs, and then the appraiser is going to note all the items that are still pending on your note on your appraisal, and then when that is done, you're going to have to schedule another visit by the appraiser at $150 to $200 cost there, right? So that then the appraiser can confirm and certify on that 1004D as in dog. That's what that form is that certifies the repairs have been completed. So you don't. It's better before you order the appraisal. Just make sure that the renovations are complete before you order the appraisal for the end loan, which in most cases will be a DSCR loan.
I did want to add to, I know it's kind of already implied, but today we're talking so much about the fix and flip, but don't forget, it doesn't matter which way you get into the property, right? You could have bought it cash and used your own cash for the repairs. You could have got a regular DSCR loan to buy it and then used your own cash for repairs. So just keep that in mind, everyone. It doesn't have to necessarily be a fix and flip. That's just a popular way to do it, especially if you don't have that much cash on hand, right? Which is all about, leveraging other people's cash, right? But you can absolutely do it whatever way you purchase it. That doesn't matter. You're going to purchase something, you're going to renovate it, and you're going to rent it out to stabilize it, refinance it, to stabilize it, and repeat the situation.
Right. The only thing I wanted to add to that was that if you do purchase that property that needs some renovation with any loan other than a fixed flip renovation type loan, you just have to make sure that the renovations that are needed aren't going to be any items that are going to affect financeability of that property under a non-renovation loan. So if the property just needs to be spruced up because everything is old, you got old kitchen cabinets, you got old bathroom, you have old AC, you have an old roof, but you're still able to get insurance because the roof's not leaking. It's not that old that you can't get insurance because it's not like 25 years old. But let's say you just want to make it look beautiful. You want to turn that shingle roof into a tile roof, and you want to replace the windows. You want to put new kitchen cabinets. I mean, that house, if everything is functional, you could get a regular loan, a non-renovation loan. However, if it's a property that's in condition that won't allow it to be financed, or if, as Kyle mentioned, you don't want to complicate your life by buying it with a non-renovation loan and then jacking up your credit cards to 100% because you ran out of money on the renovation and you had to use a credit card. Now your credit score is a 600, and you're like, wow, I want to refinance this property because I need money, and now you're stuck. You got a 600, a 620 credit score, and you can't do anything. Or, as is more common, the person that buys the property with, let's say, hard money or some other way of buying it, and then doesn't get a fixed flip loan and then just does it out of their own budget with money and credit cards, and then they need to fix, they need to finish, and now their credit's a 610 and now they can't get anything. So those are all things that should be covered in the beginning, because when you really break it down, the fixed flip loans are an amazing option when you can do, you're looking at, 85, 90% loan to cost, right? And remember, the interest rates are a little bit higher, but you're only paying interest and you're only paying for a short period of time, 6 months, 9 months, 12 months. And so it really doesn't make much of a difference in your profitability in the deal to pay 10, 11, 12, 13, 14% if your ROI on the deal, even taking into consideration that interest expense, if your ROI on the deal is 35 or 40%, right? So at that point, don't quibble on the rate if it's gonna be the vehicle to allow you to maximize your leverage, right? That's what we're looking at here, right? Preserve your credit score. So maximize your leverage on that one. Those loans, fixed flip loans, remember, they don't report usually on the credit, so they're not really gonna show up as a new loan that's gonna affect the credit score, right? That's other factors. A lot of factors to consider that in the overall big picture here are going to be intrinsic benefits to the investor to use a fixed flip loan rather than try to get what they think is creative and this and that. And in the end, I only say this because I have them come to me stuck. Yeah, I need to refinance. I'm 2/3 of the way through the project, but and then we see the credit and it's a 600, a 610, and then it's like, yeah, my credit cards are maxed out. They're over the limit. I'm like, yeah, well, now you're stuck, because we can't get the leverage that you need, or, because they're obviously, maybe they can't get it at all, or maybe due to the low score, the leverage is so low that it doesn't serve a purpose. They can't get any extra money to do anything. So that's part of the consulting that we have to provide to our investors when they're considering this, right? There's a lot, they may have some objections, but we're providing solutions, and you have to be aware of the value of the solution you're providing so they can totally understand the whole context of this process.
All right. Well, I don't see any other questions, so I think we'll go ahead and wrap it up then. Great topic here today. Remember, we also did our daily rates live show today, so you can go back to that too if you want to see some more info and see what the rates were, looking like. But we appreciate everybody tuning in. Remember, we do this Tuesdays and Wednesdays at 7 p.m. Eastern time, where we go through a different loan topic. So we will be back next week on Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer